Excellent. Thank you so much, guys. So everyone, we are here at our 9:15 session on our third day of Boston Startup Week. Thank you so much for joining us. As mentioned in some of the previous panels and presentations, if you've missed some of those, that's okay. They're all been recorded. They'll be available to everybody publicly sometime in November after we do all of our editing. Just so you know, everyone here is in the Scale Smart or Bust panel. If you are looking for any of the other sessions that are happening at 9:15, please go to the agenda tab in the top left corner. From there, you can find where you want to go and you're able to join those sessions. Before we get started, and I hand it off to Steph or Stefania, who's going to be leading our panel today, I just want to let everyone know that if you have any questions, please submit them in the Q&A tab on the right. If you do submit something in the chat area, that's fine. I'm just going to nudge you to go over to the Q&A. That way, Steph has an easier time finding your question. We're also doing a contest right now. If for whatever reason you want to pull any of the quotes from our panelists or moderator during this session, and you want to put it on social media, tagging Startup Boston Week, tagging the panelists here and the moderator, feel free to do so. We're actually going to you'll be automatically entered to win one of 5 $100 gift cards to a Black-owned business here in the Boston area. So feel free to share. From there, I'm actually going to hand it off to Steph. Steph, would you like to take it away?
Yes, thank you, Brandon. Good morning, everyone. Are you excited as I am about this topic? See, Skill Smart or Bust, prioritizing spending for growing startup. It's such an important topic because you really have to start understanding, in my experience from day one, the budget you have and how you want to spend it to make sure that this vision you have is really going to become a unicorn. Today with me, we have Chris Gardner, partner at _VC. Chris has spent over 20 years working at VC-backed company, and he also is the founder of a very successful startup that was sold to PayPal, where he spent about 5 years. And he was also in charge of the PayPal P2P payment system. About a year ago, he decided to move from startup to the startup world to the VC world. So he's still in the same type of environment, and he's joined _. Thank you, Chris, for being with us. I think that the public here doesn't know where you're coming to us from this morning, right? I know that you have a recording studio upstairs, but you also have a barn in your house in the Barbs. Is that correct?
Yeah, that's right. I'm in Dover, Mass. I've got a garage that looks like a barn and a little bit and a recording studio up here, which is actually my the best place ever to work from.
Awesome. I would love to visit. Really, awesome.
Anytime.
Yeah. See, we're becoming very creative now that we all work from home. So amazing. Another phenomenal speaker with us today is Uday Seth. Uday is VP of Operation and Corporate Development at Flywire. Uday is leading the most successful team at Flywire. They have been in charge of their recent IPO, of the acquisition of a few companies like OnPlan and Simple, and they were also the one raising money from big folks like Goldman Sachs. Uday, thank you so much for being with us. And I can go on and on with your resume. It's amazing. You have an MBA from Wharton University. And fun fact here, guys, Uday and Chris already know each other because when Chris was selling his company to PayPal, guess who was the person in charge of that M&A? Yes, Uday. So thank you for being with us today.
It looks like I'm looking at the text messages here. It looks like he's having a little problem kind of hearing his sound.
You're going to work on that in the back end, so please continue on with Steph.
Yeah.
You and me for now, Steph. Let's do this. We got it.
We definitely got it. Too bad. Yeah, this is the great of technology sometimes. It seems to work super smooth, and then all of a sudden you have a problem. How many of you have been facing those issues now? Anyway, let's really continue because the topic is really, really hot. And I want to start getting right into the number one problem that a lot of people are having, which is, in my view, to avoid mistakes. So how can we really avoid mistakes when it comes to managing the budget that we have? See, I believe that the most important thing is to learn from other startup mistakes. But I really want to ask you, Chris, what do you think are some of the mistakes that you've seen in companies burning through cash inefficiently? And how can we identify them, hopefully, to prevent them sooner?
Yeah, the challenge of burning through cash, and with startups in particular, actually how you manage all that is very stage specific. I mean, the advice that you give to companies that have raised $1 million of pre-seed funds or $4 million of seed funds is very different than the advice that you'd give someone who's at an A round or a B round or a much later stage company. But one of the classic examples of what we see sometimes is it's your biggest expense, especially for early stage startups, is typically people, and kind of either over hiring or, in particular, hiring too many people, too many senior people too soon. It's not. You often, for example, you don't need a CFO when you're a seed stage company, typically. And so kind of making big bets on lots of senior people early is one of the kind of classic ones. Of course, we've all come to realize now in COVID times, we don't need a big fancy office space anymore. And that one's kind of taking care of itself, which actually I think is great, right? I mean, real estate tends to be your second biggest expense, when you're an early stage company. And then, other mistakes we see, you hire a big honking sales team, or you make huge investments in marketing before you have what we refer to as product market fit. Before you know your product is the right one for a market, you double down on sales and marketing and all that stuff. So those are some of the few. I think I would say, and then Uday, hey, are you hearing us, by the way, man? Looks like he's still struggling a little bit. I would say that I actually see the opposite almost as much, where founders are reluctant to kind of spend into their budget and make the necessary investments. Oh, yeah. And that's especially true with founders that have what we refer to as near-death experiences, where they've almost run out of cash, or they've had to pivot and things like that. And then they'll tend to be fairly reluctant to kind of spend. And so there are mistakes on both sides. Spending too much money too soon and not enough at the right time.
It is indeed. See, I also think that sometimes it's also important, not just the amount of money that you spend for something like, let's say, marketing, but especially when it's the right time to spend those money. And you were touching on this very important topic, which is if you are developing, for example, why are you spending money on marketing? It might be just too early, too soon, right? How can we, as the startup community, make sure that especially first-time funders don't get into those mistakes? Can you tell us something more specific about maybe an experience you had with one of the company that you have maybe mentoring? And so tell us more in details how they have reacted for if you were telling them maybe this is not the right time to spend this money.
And I kind of touched on this a little bit. Rather than calling out a specific company, it really comes down to, and this is for tech investors in particular and tech startups, but it really comes down to product market fit. So if you're thinking about kind of investing, like you said, heavily in marketing or heavily in sales, you really need to be sure that you've got a product that's ready to scale. I think Mark Andreessen coined the term product market fit, and it's he said something like product market fit means you're in a good market with a product that can satisfy that market. But the founder of Superhuman kind of came up with a way to measure that, which is basically if you survey your customers and 40% or more of them have said, we'd be very disappointed if this product went away, that's kind of a good way to calculate it. At the end of the day, you need a way to figure out if you have product market fit, measure that, and long before you double down on building a huge sales force and making big marketing investments. Otherwise, you can't lead with marketing until you know your product is actually something that your customers want.
Totally agree. And see, sometimes as funders, we are facing, the problem, am I going to provide enough perks, or is that the good salary, the one that
Stephanie, how are you? Uday, Seth, I'm trying to...
Oh, guys, we do hear you.
Not getting through.
We're hearing someone talking.
What browser are you on right now?
I'm in Chrome.
Oh
I'm
gosh,
on
guys.
stage, but I've
All
kind
right.
of out of my video, so I can't hear anything.
Is this Brendan?
Okay,
Hey,
can you click
Brandon.
the settings icon on the bottom?
For the all our attendees, I'm
Can
sorry.
you mute yourself?
Hold on, I'm
as
gonna
well, so
text.
everyone can hear
Hey,
you?
Brandon, we can
Hey,
hear you.
Steph.
We can hear you
Hey,
talking,
Steph,
Brandon.
we need Uday to mute his mic while you help him, okay? Thank you.
Okay.
All right, good.
Well,
Excellent.
but
Thank
see,
you.
Uday is
Perfect.
showing one of the key important aspect of every funder: persistence. Regardless of what happens, you keep going until you make it. So we're waiting for Uday to join us. In the meantime, we were discussing something very important, which is not just allocating money for example, things like marketing, but also how do we really manage and balance culture and budget. For example, as startup, sometimes teams make huge sacrifices because they might not have salary as high as other corporates. And so funders might look for perks to offer to the team. So in your experience as well, how much do you think it's important to balance culture and budget? How much is important to offer perks to the team in order to keep them happy and engaged?
So I'd like to just say one thing there is that culture and perks are not the same thing. And this is my opinion, but I think it's important because I don't think you can buy a culture. Culture begins with the value system, respect for one another, camaraderie that comes from a job well done. You can, if I were starting a company again, I'd spend money on the things that make work better. So in COVID times, that means perhaps you're giving free, home office equipment, generous family leave, create a culture that when someone's on vacation, it really means vacation, that you're not kind of harassing them. Cocktail parties and foosball are not what makes culture. We did an interview recently with the founder of HubSpot. It's up on the Underscore website. And he talked about building culture in from day one of the company. And that's how you do it. Culture doesn't need to cost any money at all. I mean, in the early days of Paydiant or other companies that I've worked at like eDocs, we had an amazing culture and we didn't have any money. We were buying our desks at Staples and putting them together ourselves and pizza boxes. And you can have an amazing culture with no perks whatsoever. If you look at it as a value system. Now that's not to say that, things like free lunches and coffee service and all that stuff aren't important. But culture comes from something else in my view.
Yeah, I totally agree. See, I believe that the first perks is actually how good the culture is. Because if people feel happy and they feel engaged, and they feel that they are, contributing every day to make something great, they don't need free lunches or a free phone. Indeed. I love it. I love it. So let me ask you this question that probably have been asked to you thousands of times, and yet funders still wonder about it. So, how much Runaway do you recommend startup to build into their budgets?
When you say runway, are you talking about runway for if you do a particular round of financing? How much runway do you expect them to have between rounds? Is that what you're kind of
Exactly.
getting at?
Yes. In order for startups not to be out of money, so between fundings.
Yeah. So again, tough question, and of course that whole with valuations and how quickly companies are raising money these days, the whole thing is a little bit up in the air. I think traditionally you think of somewhere between 12 and 24 months between rounds, 18 months perhaps being the median. You want to rate, but really it's not just an arbitrary number of months, right? When we think about investing in a company and how much runway they'll have between rounds, we're thinking of it in terms of what are the milestones that you want to achieve. And so if we invest in a seed stage company, we say, okay, how much money are you raising? What are your milestones that you need to achieve in order to get to the point where you could raise an A round of financing? And build it that way, as opposed to kind of just arbitrary standards. So 12 to 24 months is pretty typical. But we want to see a company achieve something in that amount of time. And even these days, it's not as easy as saying, hey, in order to get an A round, you need $1 million in ARR, right? It's growth rates, it's the beginnings of product market fit. It's kind of all of those milestones. So I'm reluctant to say that there's a hard and fast rule on how much runway you build in. We typically say 12 to 24 months, but it's the milestones and what you're achieving that's much more important.
Indeed. Hey, Uday.
Yeah, I see Uday nodding and stuff. Does that mean he hears us?
I can hear you perfectly, Chris.
All right, man. Giddy up.
You would think that after 19 months of sort of the Zoom culture, I would have figured things out by now, but it's still clearly a work in progress. So appreciate it.
I thought you were going to make me carry the whole ball on this thing, so it's welcome.
Just to the 30-yard line. Thank you, Chris.
So Uday, thank you for finally making it, and it's great. See, I was mentioning before, persistent. It's really, really important when you are running a startup. So I do have a couple of questions for you, and I want to go straight to that. How about financially modeling and forecasting? See, we were discussing about how to prepare in advance to make sure that you don't burn all your runaway. But how about the time that you should spend on creating modeling to make sure that you have the situation under control? And what role VC or strategic mentors can do in helping you evaluating what is the right financial modeling you should build?
For sure, and I'm super curious to get Chris's take here as well, but I'll kind of start from the company perspective. So I kind of think about three different aspects. So there's strategic planning, then there is what emanates from strategic planning, which is budgeting, and then there's long-term forecasting. As we think about as we've gone through the fundraising process at Flywire from our series D, E, and F, and then through sort of the IPO, there's a certain amount that I'd say is sort of the focus on sort of financial modeling and forecasting. And really, if I'm to wear sort of the hat of the CFO, the modeling should accomplish two big things. So the first is it has to get sort of investors and potential acquirers and whomever else comfortable in your revenue for this year and your revenue for next year. You're solving for the what do you have to believe, and you can make sort of the investor's life so much easier if you can bridge sort of the assumptions between where you are now and where you are in T plus 12 months from now. I'd say that as you sort of think about balancing sort of shorter term forecasting with longer term forecasting, I think it's kind of the 80-20 rule in my book, where you spend 80% of your time figuring out what's T plus 12 and T plus 24 months. Whereas an investor or a VC, projections 3 years out, I think are kind of hard to ascribe that much value or weight to. But at a certain point, a VC or a strategic acquirer, they're basically betting on, one, can you execute short term? And two, is the market big enough where even if you're off by a bit in sort of your 2024 and 2025, you've still got a big enough market and you've still got the right team to be able to execute. I think the second part of what I'd counsel in terms of what the focus is, that there are really two big metrics that need to come out of your financial modeling for fundraising and for going down a different route. One is client growth. So understanding this concept of net revenue retention and where growth is going to be coming from with your existing installed base is a vitally important sort of metric that VCs really spend a bunch of time on. And then the other piece is unit economics. So calibrating around, one, what does the segmentation of your customers look like? And is it an instance in which a small handful of your customers are driving a disproportionate amount of revenue? And then two, understanding what paybacks look like. And Chris would sort of pick your brain and would love to hear sort of what the heuristics are. But one of the metrics we often have been asked about is something like lifetime value over customer acquisition cost. And really the sweet spot is a metric of over 3 times, between 3 to 10 times, where anything less, you're in a market which involves a ton of selling and a lot of maintenance. And anything sort of above 10 means you're probably not investing enough in sort of customer acquisition.
Yep. Yeah, one of the interesting things about this discussion, of course, and just so reminding everybody, Uday's at a newly minted public company for which forecasting and everything is existential, as you have to talk to your investors each quarter. And as an early stage investor, it's a very different it's a very different set of metrics. So we're a seed to Series A firm, and we spend actually a lot of time getting companies prepared to build predictability into their business. You know, when we're taking a pitch from an early stage company, we take every forecast with a grain of salt, because very often they haven't even built the product yet, or they're just building the product and don't know how it's gonna land. And so we certainly get some chuckles sometimes at, you know, these incredible forecasts that kind of go out 5-year plans and all this stuff, just knowing that it rarely turns out that way. But what we do like to do, and as we kind of lean into early stage company building, we like to help them prepare, you know, between seed and Series A, and then certainly by the time a company's at Series B, they need predictability. And depending on the business model, you know, whether it's LTV to CAC or you know, and start worrying about things like, you know, even margins and all of that stuff, that comes later. But in the early stages, mostly we want people to begin to be able to predict, and that starts with building the processes and everything. It starts from the very beginning. Can you even forecast your sales process? You know, often we companies, the founder's the one doing all the selling in the early days, and so you start with building the underpinnings of being able to measure what you're doing, and then, as you're stating, you start to kick into standard SaaS metrics, of which there's, you know, tons and tons of articles on.
Yeah. So, Chris, this is true. Sometimes we got some distraction, or we might be misleading when we are creating our budgeting process. So, Uday, what have you seen being the biggest distraction points during the budgeting process?
Yeah, so there are a couple. I think the first is assuming a certain level of precision in budgeting. I think what I've seen work quite well is budgeting is principle based, knowing that you're going to be spending most of the time focused on what are the priority areas for this year and how do you organize headcount and planning around it, rather than solving for the last dollar of where are you spending on company swag and company culture. So what I think the biggest trapping is sort of over precision and over engineering rather than sort of a principles and rules based approach to it. I'd say that one other check and balance that we found to work quite effectively is sort of this matrix of more in R&D spend, but sort of this matrix of innovation versus scaling versus BAU. And oftentimes throughout a budgeting process, it's easy to get caught up in the BAU and sort of fight fires, but think of budgeting as sort of being an output of strategic planning and making sure that you're actually casting innovation and scale types of investments as well. This is probably something that, to Chris's point from earlier, probably less a primordial focus for a seed Series A, but as you think about sort of Series B, C, and D, where companies are sort of scaling in sort of a multi-vector way, probably becomes more important.
Yeah, you make a great point about false precision, right? I mean, and I've kind of lived through that at the early stage and at bigger companies like PayPal. And you know, there was a point in time where, you know, people were actually trying to do things like, you know, lines of code per engineer and kind of this crazy focus on things like that, as opposed to kind of an outcome-based management. Because to your point, you want to create strategy, tactics that follow out that strategy, and, you know, create money pools and budgeting that lets you achieve milestones, whether you're a big company or a smaller company, as opposed to trying to create it to hone it down to the last dollar, which is difficult and almost impossible at a huge company.
Yeah, absolutely. And indeed, guys, you have both discussed about how this budgeting process totally changed if we're talking about an early stage startup or more of a growth stage startup, especially pre-IPO. So Uday, you with your team have been leading the IPO of Flywire. Can you tell us more about this experience and how we should think about budgeting and financial planning for companies in the pre-IPO stage?
Yeah, so I'd say that there are really two things, two things that were sort of key learnings for me, and one of them is you can spend all the time putting together Excel spreadsheets and sort of, again, to Chris's point about false precision, debating the $5 million higher of revenue in 3 years from now, when in a certain point you just don't know. So I'd say that straw mans and general structures are probably where to spend more time rather than sort of debating where the last dollar revenue comes from. I'd say I'd actually over-index to spending more time on sort of researching things like total addressable market. And even in context of IPOs now, right? Because if you think about sort of the tech place and sort of what investors are buying, they're buying growth not just for the next year or the year after that, but they're buying sort of your ability to access massive TAMs. So I'd kind of say forecasting and financial modeling is important, but it's just as important to sort of know and be able to articulate just how big the market is you're choosing to sell into. And I'd say that discipline around sort of areas like marketing and sort of knowing your customer acquisition costs and understanding sort of how cohorts grow. That's an exercise that's relevant whether you're pre-IPO or even earlier stage, because again, whether you're raising a Series B or C versus going public, understanding where growth is going to be coming from is vital. So looking at things like cohort vintages and sort of how customers pay back over time, I think is sort of parlance that exists throughout sort of a company's life cycle.
And enough self-reflection that you're willing to pull the plug on something that's not working. Again, this is kind of universal, big company or small company. If a marketing program's not working, you need to be measuring it well enough to understand that and pull the plug. And it's just as true on a product initiative, right? Like, you're not going to get it all right. And being able to kind of, accept the fact that, hey, this isn't working. We need to do something different. Let's not keep throwing good money after bad. There's a lot of discipline there. In the early stage of a company, that could be the difference between life or death, right? Just deciding to kind of pivot when something's not working. But even at a big company, if you're going to, be efficient, you need to be willing to kind of acknowledge when something's not happening.
Absolutely. See, in my experience, I've seen sometimes early stage startups focusing so much on the product and not going out there and test it out and trying to find product market fit because they feel the product is not fully ready yet. And this is, in my view, like a strong limitation. Because a product is never going to be perfect. You're going to continue to evolve and keep building as clients come in and going to ask you more and more features on the product. So, Chris, what do you think should be the signs that funders should look for and to understand when it's critical to continue to invest in product or R&D, for example, or it might be about the time to start using more money towards sales and marketing?
So, I hinted at this before. It's for us, it's all about product market fit. Like, a company shouldn't really even think about scaling sales and marketing until they know they have a product that customers want. And there's lots of different ways to measure it. I talked about the kind of 40% would be very disappointed if it went away. That's kind of the superhuman model. But what you really want is, you want that flywheel start to work on its own. You want customers that are pulling the product from you rather than you having to sell it. And this is in particular true about, SaaS companies. So you really need to do that. And there's no shortcut for talking to your customers and building the tools to talk to your customers to see whether that's true or not. So you have to do that. And if you do that, the way we talk about it internally at Underscore is, have they achieved product market fit? And then, and only then, do you talk about really building out a sales force. Because it's a very, very powerful thing. If you have product market fit and you're confident in it, you are now at a point where you are certain that if you add 2 sales reps, or if you add $1 million a month in marketing, you know exactly what that's going to turn into in terms of revenue. And that's what you want to do. If you do it too early, you have no idea what's going to happen. And you run the risk, at least at an early stage company, of chewing through cash unnecessarily.
Yeah, exactly. Sometimes funders probably don't look outside their small team for mentorship, and this is a problem. Indeed, probably the more I believe you can bring people brainstorm with you on budgeting allocation and the process, the best it will be. So, Yude, let me ask you this question. How do you think funders can really bring on the table different stakeholders to discuss spending, maybe from a top-down approach, and benefit of, experiences from people like Chris or yourself?
Yeah, so I'd say that in terms of sort of how a founder can sort of build alignment and consensus around where and how to spend money, I'd say that think of budgeting and the actual presenting to the board and presenting to smart folks like Chris as sort of being the logical output of deciding what's kind of two questions. One question is what the North Star of the company is 2 years from now, 3 years from now, knowing that what the North Star is kind of changes. And then for the next year, what does that mean in terms of investments and bets we want to make? And when you kind of frame it that way, you end up being more principles based about budgeting, where you're hiring certain people to sort of work on specific mission critical tasks and mission critical initiatives. So it kind of it becomes more a question of what are those specific initiatives rather than a question of are we spending the right amount and in the right way is kind of the way we've approached it.
Yes. So, guys, we got some questions from the public, and I think we can open them up. Am I doing my math wrong? Do we still have 15 minutes, or do we still have 30 minutes? Sorry.
I thought we were going to 10:15.
Okay, then we still have 30 minutes.
I think I'll double check that. You keep going. I'll double check the
All
agenda.
right. So let me just start asking a few questions, and this is actually pretty funny in a way from Dana Allison because it is so true, Dana. So early stage startup are building. Early stage startup equal 12 months budget, 3 to 5 years projection. Okay, Dana, I'm so sorry. Can you try to rewrite your question? I don't fully understand it. So let me go with Danne, that she also has a really good question about budgeting. So since we all know that the even 3 years old projection for a seed company is pure fiction, why do VC insist on seeing the projections?
So I'll tell you why I like to see it, because it helps us think about how the founder thinks about their market and the trajectory of the company. We don't put a lot of stake on, what a 3 to 5 year revenue outcome is. Like we don't say, okay, they're definitely going to do this in year 3 or 5, but the exercise itself is useful. It helps. I believe that it helps companies kind of think about the growth potential of their business and milestones that could happen along the way. And for us, being able to get a window into how they think about that is actually super important, even if we know that those 5-year numbers are hand wavy. A founder that says, we're going to be doing. We learn something when a founder says they're going to be $100 million business in 3 years, or if they say, you know what, we think we can kind of get to 5 million ARR in 3 years and be ready for a Series B. That tells us something about conservatism. Whether they're living in a fantasy land, whether they're conservative, and then the supporting data under that model. The kind of level of thinking there tells us something about the entrepreneur. Again, even if we don't put a lot of stake in the actual number. Hopefully that's helpful. It's useful to us, and we think it's a useful exercise for founders, but it's not the be all end all.
I would also just add that at least from sort of the corporate acquiring standpoint, projections are exactly to Chris's point helpful in that they show something sort of about the company, but if you're sort of investing or acquiring in a new industry, there's something to sort of be said about how a new industry ramps and sort of more sort of market intel on an industry itself rather than just on the company. So I think that they're good data points there too.
Yeah, absolutely. So Dana, thank you so much for clarifying your question. Apologies for not fully understanding it before. But Dana is asking, what is expected or reasonable for an early stage startup to have and work off a 12-month budget and that 3 to 5 years projections?
I mean, I think I understand the question, and I could take just a quick stab. Look, in the early stage, like if we're investing in a pre-seed, kind of pre-revenue, pre-product, or a seed company, we like to see some projections out there, but it's much more important, and I think I talked about this earlier, that there's a milestone plan for what they intend to do with a chunk of money. So if they're raising $3 or $4 million, what do you expect to achieve over the next 12 to 18 months with that money, and what are the milestones that you've laid out for yourself to achieve. Now that I do think is valuable, and not only does it tell us how the entrepreneur thinks, we know how they want to spend the money and what they think is realistic to achieve in order to get to the next stage of their development. So that's actually one of the more important things that an entrepreneur, in my view anyways, would do, which is really kind of be thoughtful about what their milestones are for the next round.
Yes, indeed. Awesome. So I have a couple of questions for you guys, just to go a little bit deeper about what we have already touched. But what are some good ways to analyze spending decisions? Like, really give us tangible tips that funders here can use, so that once they avoid mistakes too, they do an amazing job, and they can really make sure that those are what they are calculating are not just projection, but are real numbers. What would you say?
Yeah, so
Good
let
ways
me
to analyze spending decisions. Yes.
Yeah, sure. So kind of a couple different ways that I would sort of answer the question. So I'd say tactically, from sort of a sales and marketing standpoint, it's actually a fairly easy exercise to measure sort of the return on sales and sales heads. I think it's just a question of enacting some kind of discipline around that. And to the point about sort of where in the budgeting process do companies early stage make mistakes? Oftentimes, early stage companies skimp on basic tools on measuring returns. So something like Salesforce, for instance, and maybe not Salesforce, but basic sales tracking tools that are vitally helpful in sort of tracking ROI are often sort of the last spend that companies have. So I'd say that's probably one thing, just having sort of an apparatus to which to measure. And then the second bit I'd say is, I guess, less spend, more sort of focused on sort of areas of time and areas of attention and focus. I think that's why sort of an OKR culture is quite important, right? And then maybe less sort of relevant at the very, very early stage, but sort of the more mature you get as a company, having OKRs to tie sort of specific initiatives to, and having those OKRs be quantifiable, measurable, and tied to some form of return is vitally important, because there's the dollar spend, but just as important, there's mind share and attention share and sort of overall distractions. You want to make sure that what you're actually investing time and attention in delivers returns. And you can have sort of 3-month, 6-month, 9-month, 12-month cadence for that, but it's not something that needs to be tracked sort of on a week-to-week basis as much.
Yeah. I'll just put an exclamation point on what Uday said, is that job one at the early stage, and we spend a ton of time focusing on this. Don't worry about metrics until you can actually measure them. And so put the frameworks and the tools, whether it's Salesforce and measuring your funnel, measuring your return on digital ad spend, measuring customer satisfaction, things like that. First, get the tools in place to be able to, measure, because you don't know what you don't know, and then it becomes a relatively easy process of understanding return on investment.
So right. And see, this is indeed, it's making me wonder, how can funders prepare for unexpected expenses or revenue loss that can really tangible affect the budget plan?
You kind of flagged this question early on, and I had a hard time coming up with a good answer in the context of early stage companies. Because the absolute dollars that companies are operating from in the pool of dollars is actually quite small, and so it's not like I've rarely seen a founder, and I certainly never did at any of the companies I was at, where you carved out a rainy day fund in particular for some unforeseen circumstances. And we saw with COVID that a lot of companies kind of went through hard times, right? Because something like that, there are certain things that you can't plan for, right? Something existential, macroeconomic conditions, a pandemic, a natural disaster, stuff like that. What you do want to do is have enough padding in a budget that you can accommodate kind of day to day. Maybe you miss a quarter, you want to be able to have a budget that can survive you missing a quarter or two, things like that. You don't want to spend every last penny, or at least have the ability to reallocate funds if something bad happens. You miss a quarter or something like that. But it's super hard to It's super hard to plan for everything. The one thing I would say, and again, this is for early stage investors and kind of less ethical probably to a public company, but your investors really matter in the early stage. You want an investor that if things go sideways for unforeseen reasons, right? There are lots of reasons companies fail, and one, you know what, it's not the right founder, or they didn't do a good job executing, or they couldn't build the product in time, and things like that. But if there's an unforeseen circumstance of something, that's where the quality of your investors and the willingness to kind of support the company through a rough patch is super important.
Yeah, can I add to that? Because what is very important, guys, is that you have a very open and transparent conversation with your investors, okay? No judgmental. It's just they are there to help you. And so the more you can open up, the more you can be transparent, the more willing they will be to really help you go from stage 1 to stage 2 and keep growing, even when bad things happen, which can happen.
And yeah, there's lots of startups that raised kind of interim financing during COVID. You know, if their business was particularly susceptible to it for some reason, and they, you know, might have raised a little bit of interim financing to kind of get over the hump and things like that. So there are reasons, there are ways to navigate that stuff, but you need a good relationship with your investors.
Yes, absolutely. So here we have a question. From Mayur, when is a good time to raise money? You should know if you're the funder. You should
right
know.
Now. we're in an unbelievable time for founders right now. You know, there's the market is awash with capital, and good founders with track records, or a what we refer to as a kind of right to win in a particular domain, can raise money. And if it's not from us, they can raise it from lots of other people, because there's, even in our business, is unbelievably competitive. When is a good time to raise money? In my view, again, at early stage, and there's a whole set of different answers that they could have about kind of late stage companies, is actually a very personal decision. It's not as, there's no kind of hard and fast rule. Folks that have the ability to raise money from friends and family and start a company, or bootstrap it, or have a consulting business that can kind of pay some of the bills to start. It can be a very good thing to kind of build some of the product on your own nickel and get there and get a better valuation and be less diluted when you raise money from VCs later. On the other hand, if you think you've got an idea but it's hot and you really, really need to move quickly right now, you can kind of pull the trigger and raise money immediately. So there's a lot more to that question than can be answered. It's so situational and personal in some cases. Hard to answer specifically, but from a macro perspective, it's a terrific time to just raise money as a founder right now.
The only thing I'd add to that, and I think Chris laid it out particularly well, is that the investor matters, especially at the early stage, where finding sort of a step function type of investor that's going to make introductions, that has deep subject matter expertise, strong operating experience, that is a true partner, I think particularly matters. So if you're deciding to raise capital in a year from now, but you just happen to connect with the right investor that you think will be a super strategic fit, then there's no reason to sort of tie yourself down to timelines.
Totally agree with that. Guys, it's not just about the money you raise, it's also who you raise it from and what they can bring to the table to help you. Very, very important in my own view. And this goes to Raymond's question. He is probably in healthcare. And so he's asking, can you recommend any investor resource in the healthcare industry?
Yeah, why don't we push that one offline, and then we can do is we can kind of publish to the attendees. We can publish some lists and some resources. We have some folks that specialize in that on our side, and I'd be happy to kind of pull a list of links together and get that out to folks.
Awesome. And then from Francis, what is the best process for raising money in today's climate? So Chris, you said this is a really good environment right now, a lot of money flowing. But what is the best process? Is it better to leverage connection first, or simply get out there and as much as possible?
Yeah, Francis is kind of answering his own question here, I think. Always better to get warm introductions. We at the early stage, we're really investing in people. And anytime, it's super helpful for us if it's part of the reason, as at Underscore, we've developed something called the core community. And, many of our investments, in fact, most of our investments come through referrals in that community. That's, thousands of people large, because that gives us insight into team members. The first thing we do when we look at anybody, even if we get, a deck cold kind of through email, is go to LinkedIn and see if we know anyone that knows that person, so we can find out more about the person. We can obviously, read their background in LinkedIn, which is, phase one. But warm introductions are really, really help, because we want to know people as well as possible. So I would not recommend, blasting out a deck ever to as many, email addresses or kind of cold through LinkedIn as possible, but instead focus on a few, do some research, understand if they actually, first of all, go through their portfolio companies, understand if they actually make investments like what you're doing or in that domain. And then if you're going to do a cold outreach, do it to the particular partner that invests in companies that look like you. So that's not to say you can't do cold, but don't do a shotgun approach. Do your homework, do your research, much in the way we do a research on founders, do research on the partner, find out what investments they've done, reach out to them with a warm email that will land well, because you've done your homework. But don't do the shotgun blast.
I think this is one of the things that resonates particularly well between sort of early stage, medium stage, late stage, which is you want to be particularly disciplined about your investors, and a cold shotgun approach kind of spreads you sort of thin, no matter where in the life cycle of a company you are. So, and the more time you frankly spend with a set of investors, the more you get to know them, the more you can sort of discern whether or not they're the right partner. So, exactly Chris's point, focus on a few and spend a lot of time with the few that you do choose to spend time with.
Yeah, and as a follow-up, I also want to say, too often startups talk to investors not having an equal conversation. So guys, investors are the one that have the money, but you are the one that is bringing them an opportunity, okay? So make sure you really feel confident to discuss about this opportunity. And again, talking about what resources are there to educate funders, where Bernadette is asking, can you recommend resources to learn more about investor, the sectors they focus on, how they tend to exit? She's referring to Crunchbase, but are there any other resources out there?
I actually, and Uday may have a different opinion, but I tend to think that there's a better approach than even Crunchbase. I mean, that's for kind of, looking at the investor market as a whole, but I think it's better to understand your market really, really well, and the companies that look like you and who their investors are. I think that's a much more effective way than saying, who are all the healthcare investors? Try to find the lookalikes for your company, find out who their investors are. Now, typically investors won't invest in a company doing the exact same thing, but they will invest in sectors, and doing it that way, and then going after investors saying, hey, noticed you invested in X, Y, and Z. This is what we do. Would you be interested in learning more about our company? I think that's a better way to curate your list than kind of, going through a database. And it has the side effect, of course, of you knowing your market intimately.
Yes. And then we have a question from one of my mentees. So amazing Diva is asking, when raising money, does geography matters? For example, if the business is based in the US, then raising from global investor, is it effective?
You want to grab that one, Uday?
Sure. So I guess I'll sort of transpose some of my sort of Flywire experience. So we are a global company. We've got 12 offices internationally. We've got, in fact, most of the team is based internationally at this point. From our standpoint, raising capital internationally, especially from an investor like Temasek, was a no-brainer. Specifically because so much of our infrastructure, the way we move money is based internationally and based on international relationships. So raising money internationally from international investors was a particularly good accelerant for our business. So I don't know if there's a heuristic to say that if you're a U.S. company, you should still consider raising money globally. But again, if you are sort of under the belief and under the premise that most companies are going to be global in some way, shape, and form, it's never a bad idea to sort of look internationally. But for us, it was particularly important.
Yeah, if I was giving advice to an early stage founder, for me, the marker is, we often say, you want to invest in the partner, not the kind of the firm logo. But similarly for international investors, if you are on the cusp of expanding internationally or already have an international component to your business, it's a no-brainer to have an investor that could potentially help you in those efforts. Because one of the things you want most out of an investor in the early stage is someone that can actually help you with customers, with hiring, with introductions, with regulatory stuff, blah blah blah. But if you're brand new, you're U.S. based, no plans to kind of do anything internationally, at least for the next couple of years or before the next round, I would always recommend you find an investor that's going to be close enough to you to be able to lean in and help you grow your business. And that's not always the case with an international investor. It's harder for them to do, certainly.
Yeah. We have a couple of questions for, I believe at this point, later stage funders. Because Alex is asking, how can you best prepare to raise debt from a traditional bank?
I'm going to let you take that one, Uday.
Sure. So we've contemplated and gone down the route of sort of venture debt. Really, the bank's perspective is a fairly easy one to understand. Whereas an equity investor or a VC investor thinks about, well, what's my upside? A bank investor that's investing in debt always thinks about, what is my downside? And it's very clear based on sort of the processes and committees that banks have, which is truly understand what's their loss exposure here if this company goes belly up. So to that point, the focus on unit economics, the focus on sort of the underlying gross margin potential becomes that much more important for a bank. And even things that in foreign concepts, some foreign concept called EBITDA starts to take hold and starts to sort of play more prominent. So being able to articulate sort of a path to profitability and articulate sort of why the businesses can be underwritten from a debt standpoint is particularly important. Basically solving for loss aversion and making sure that the downside is fairly visible and where a downside scenario would be and being able to articulate why that won't be the case.
Awesome. Thank you. And now we have a question from Angela about product market fit. How would you recommend to do product to market fit when working with a huge corporation? Start from bottom up or coming from top to bottom? In other words, will you start talking to the CEO or to the end user?
Yeah, so obviously it's super hard to survey CEOs, and I don't think you need to talk to a CEO to understand if you're building something that a company wants. There are a variety of ways to measure product market fit, but the most important one is if you sell a company something that they don't churn, and preferably buy more services from you, and then perhaps recommend those services to others. They become, in effect, salespeople for you, and you can see it in the trajectory of your sales. That if you are closing, you give it, and I'm talking about B2B here, for example. If you're closing a high percentage of deals in which you give a demo, those customers tend not to churn. They tend to buy more from you, more seat licenses or more API calls or whatever it is. And that you have clear signs that the only thing holding you back is that you need more reps to have more conversations. That's a better measure than worrying about which person you're talking to at a company.
Yeah. Might I also say it is very important that you already know who are the decision makers for your specific product, because sometimes they can be even more effective than just talking to the CEO, because those are the one that you're solving a key problem, and those are the one that can really move forward to say, I want this product. So it depends what you're selling. Let's say you're selling a software, then probably head of IT. All right. And then he will be the one presenting this to other decision maker at a higher level, like the CEO.
Yeah, it's a great point, Steph.
Awesome. All right, cool. Matthew, I love that we have so many questions. It really means that, guys, we're here to really help you. And this was the whole purpose of the event. So great. Keep going with the question. We don't have much time, but we're going to try to answer most of the one left here. So from Matthew, how has your diligence process, you mean due diligence process? No, diligence process changed given that good deals are more competitive and priced higher than ever? So I guess this
Yep.
is a question for Chris as VC.
Yeah, so I'm a relatively newly minted VC. I've been at it for less than a year, and when I kind of jumped into the pool, part of the reason I liked Underscore is that we really do what we call do the work, and we spend a lot of time kind of understanding the founders, understanding the company, understanding the business, the market, et cetera. What I've found is that I jumped into kind of a market environment that is moving very, very quickly. It's very competitive, and one of the results of that is pace. Very often, you don't have a few weeks to do due diligence or a month to due diligence for particularly competitive deals. And so I wouldn't say that our process has changed. We have kind of the same, benchmarks or things that we like to see in companies that we invest in. But we have to move fast. You're in some cases, you're seeing, if you look at like Y Combinator companies have term sheets before they even get to demo day. Very often, companies have a stack of term sheets to choose from. Sometimes you get to meet a company late in the process that already have investors lined up. Great time to be kind of a founder. And it just means we have to work faster because you want to be fair to the founders, and you need to make kind of a quick decision and not create more work for them and their company. But the onus is on us to get moving. I think that's the biggest thing. Is the pace.
Awesome. All right. I think I'm gonna take this last question. Then I have another one I want to ask you guys. So another question from Diva. She's asking, when you're reaching out to the investor for the first time, should you already start asking for money, or should you first build some level of trust so that investor can get to know you and your company? You ask for feedback, and then later on, you keep asking. You are gonna go back asking for money.
And Uday can also answer some of these, based on his time on the other side of the table with PayPal and others. But it's assumed if you're having a conversation with an investor, it's assumed that you want to raise some money. And I would always lean on it. It's not. I know personally that the context of the conversation is that this person wants to raise money, and more often than not, I'll, as part of even the initial conversation, saying, "Hey, where are you in your funding process? How are you thinking about raising money? Do you want to raise money?" And very often these days, the founder will be like, "Well, we're not raising now. We're kind of building relationship building," which is also fine. I would always, and this is just my personal bias, but I always lean on the relationship just in general. I think I'm interested in meeting founders even when they're not raising money, just to build a relationship and get to know them so that that they remember me when the time comes. And I think founders should think of it the same way. There's an assumption that raising money is part of the conversation at some point, so I don't think you need to be shy either.
I would sort of just say from the sort of the company M&A standpoint, if you're looking to cultivate relationships with potential acquirers, always best, again, in the spirit of what Chris said, to build relationships first. Let a potential company that you think is a good fit for a potential acquirer one day, to sort of build relationships, build that trust first, because it makes all the diligence aspect that much faster and that much easier as well.
Yeah, we had, Uday back in the day, when we worked together on the PayPal thing, I mean, we had a good solid 3 to 4 months of kind of conversations, right? I mean, kind of leading up to anything, it's probably 6 total on a transaction. Like it's a long relationship building process, whether you're investing, and that's not to say it moves faster, obviously, in the venture world for a small round of funding, but relationships matter. People matter.
Yeah, at the end, people are the one that are making the difference. So I would just like to ask one line from Chris and one from Uday about budgeting. What's your one line about budgeting, Uday?
Focus on the important things. Don't solve for the last dollar.
Oh my God. Oof. Rate it. Love it. Chris?
Yeah, make it milestone driven. Money is a means to an end, not just a planning exercise.
Exactly. Well, guys, I hope you enjoy this section. I love it. Thank you to our phenomenal speakers, Chris and Uday. Thank you so much. Please do not miss other great events during the Boston week. There are plenty of other events that can help you progress towards your goal of creating a unicorn. So do not miss them. Have a wonderful, wonderful day, everyone. Bye.
Thanks, Steph. Nice job.
Thanks so much.
And for those of you who are still with us, I couldn't have said it better myself. Steph, thank you for that segue. We will have our next session starting in about 15 minutes. If you want to navigate towards the agenda tab for the panelists, feel free to log off. Or if you want to meet backstage, again, by hitting the switch button at the bottom right, feel free to do so now. And thank you again from the organizer team for taking time out of your days and volunteering your time to talk about something that's very pressing on every entrepreneur's mind on a regular daily basis. So thank you so much.
Super fun. Thanks for hosting.
Thanks so much, everyone.